Howdy, Jacob here. Today we're looking at Roper Technologies in the industrial conglomerates industry. 60.7 billion market cap on 67.7 billion enterprise value. Huge, huge company. Founded in 1981 out of Sarasota, Florida. They develop software and technology enabled products and solutions. They operate through application software, network software, and technology enabled products. Okay, revenue is pretty solid. You're looking at maybe mid to upper single digit growth year over year. And the revenue side, 3.5 billion to 6.2 billion in 10 years. Gross margin up, operating margin relatively flat, but humongous. A 28% operating margin is absolutely massive. They do pay a dividend, but it's very minor in relation to their earnings per share. So if that's the same case on free cash flow side, no concern there. Return on invested capital is mediocre, a 7 to 9% return on invested capital, probably right in line or slightly lower than the weighted average cost of capital, but we're still not terribly concerned by that with the type of margins that they're getting. Balance sheet shows 214 million cash on hand, 500 million short-term debt, 5.8 billion long-term debt. So this company does have a little bit of debt, and it has been growing. Their free cash flow, huge acquisition company. The company's been growing incredibly through acquisitions. That's a lot of their free cash flow. It looks like they've really been going to debt to fund some of these acquisitions as well. And so right now their use of free cash flow is on the dividend side, very minor, about 300 million. You're probably looking at 20% here. Um, 300 million, 20% would be about 1.5. Yeah, that's pretty reasonable. And then really 80% towards acquisitions, maybe even more since they've been going into debt to fund some of those products. So for me, I'm going to be conservative and I like to review their capital allocation and also justify it with what I think they should do. Right now, they have a lot of debt, so I don't have to go exactly what they've done in the past because I think that they shouldn't they don't need to outdo their capital allocation through to fund their capital allocation going towards acquisitions doesn't need to be greater than their free cash flow. And so for me, you will see smaller revenue growth than what's been in the past because right now, again, we're showing about 80 to 90% of free cash flow going towards acquisitions, 20% to dividends. I don't think that dividends going away, but I do think acquisitions will slow down and I will start putting in maybe 10, 20% of free cash flow to go towards debt reduction because if we're looking at a 1.5 billion free cash flow on a 5 year average basis, they have almost six times that in long term debt. And so this company will have to focus on debt reduction at some point. And for me, being the conservative investor that I am, and them being around since early 1980, I think that debt reduction is a smart move for them. And I do think it'll hinder their growth, but I think in the long run, it will be beneficial for them. So for me, on the revenue growth side, they've been growing upper single digits. Maybe because I'm going to dampen those acquisitions down a little bit, I'm comfortable with a 5% growth rate. They're still going to be utilizing 50% or so of capital allocation towards acquisitions. That'll hit that top line, and they've historically been decent at hitting the bottom line or at least staying consistent. And so I'm fine with that. For margins, I'll probably stick around this 24, 26 range. I think that's fine. Share change, they have been increasing shares a little bit through stock-based compensation and just through shares. And so let's say 600 million is 1%. 60 million is okay. So let's do an increase of about 0.03%. So that's just their stock-based compensation. What they've done historically, I think I'm comfortable with that. And then their PE, again, I like to go off of enterprise value as much as I can. And here, with a little bit of debt reduction, I think that we can do a PE price to free cash flow slightly lower than the market. Because again, I do think that their growth is pretty solid, but their growth is through acquisitions, and their return on invested capital is good, but not great. And so for slightly lower than market, I think I'm comfortable with that. 15% return. Their dividend, I'm not going to be increasing that as it's currently 20%, which is very small, but I do want them to minimize acquisitions a little bit to pay down a little bit of debt. So I'm going to assume about, um, let's see, I guess, what have they done with dividends in the past? Okay, they have increased it. So let me increase it with their revenue growth to say that they still increase dividend 5% a year, but it's still roughly 20 to 25% of capital allocation. Again, 50% to acquisition to get this type of growth rate, these type of margins. And then now we're looking at about 20% or so for debt reduction, which I do think is important for more established companies that don't have a lot of growth necessarily ahead of them outside of acquisitions. So for me right now, it does look a bit on the expensive side. And I mean, the margins are great. This PE, I think it's a bit too much for the type of growth you're going to get and the type of growth that it is. It's acquisition growth, which again, they've done all right at hitting the top line and the bottom line. But again, they haven't done acquisitions to necessarily really efficientize the business because the margins have been very lackluster. Well, margins are great, but they haven't been increasing, is what we would want. The company becoming more efficient, meaning that you don't. If you were to increase revenue 3% a year, you could increase earnings 5 to 6% a year because you're hitting the bottom line more. It doesn't take as much to really make some money here, and so right now, again, just looks a bit expensive for me. I want to be waiting, looking at other companies in the meantime. Hope you enjoy the video. Have a great rest of your day. Thank you.